I have spent the last 40 years watching money move. Not just the money in your pocket, but the massive oceanic tides of global capital. I have watched trillions of dollars flow between nations, between industries, and between generations. I have advised sovereign wealth funds, pension systems, and governments on how to prepare for the future. And in all those decades, through the crash of 1987, the dot-com bubble, the great financial crisis, and the pandemic, I have never been as concerned about the average investor's preparedness as I am right now. We are standing at a precipice, a structural, fundamental shift in how the world works. For the last 30 or 40 years, we lived through what economists call the Great Moderation. It was a golden era for the passive investor. Interest rates were falling. Inflation was non-existent. Globalization was making everything cheaper. You could buy a standard index fund, close your eyes, and wake up 10 years later wealthier. It required no strategy. It was a rising tide that lifted every boat. I am here to tell you with the full weight of my experience that season has changed. Winter is here. The era of easy money is over. The era of set it and forget it is over. The map that worked in 1990, in 2000, even in 2015, is now a map for a world that no longer exists. If you are approaching retirement or looking at 2026, wondering how you will secure your future, you need to listen carefully because the old rules will not protect you anymore. The standard 60-40 portfolio is facing an existential crisis. The assumption that inflation will always be 2% is dead. Most people are sleepwalking into this new regime. They are holding cash that is silently burning away. They are holding bonds sensitive to volatility. They are holding stocks built for a zero interest rate world. When I meet with retirees or people 5 years away from retirement, I see fear. The fear of longevity. We are living longer than ever. A couple retiring today at 65 has a high probability of at least one partner living to 90 or 95. But financially, it is a massive challenge. You have to fund a 30-year retirement. That is not a vacation. That is a second life. In the old days, you had a pension. Today, the risk has been transferred entirely to you. You are the chief investment officer of your own life. And most people are trying to solve a 30-year math problem with short-term thinking. This brings me to the first asset class you must own before 2026. Asset class 1, infrastructure and real asset. If you look at the portfolios of the smartest sovereign wealth funds in the world, Norway, Singapore, the Middle East, you will see a massive shift occurring. They are moving money out of paper assets and into real assets. Infrastructure, not buying a construction company stock. And the digital infrastructure. AI and the cloud exist in massive data centers. They travel through fiber optic cables under the ocean. Every time someone uses AI, they are using physical infrastructure. So asset number 1 is diversified exposure to global infrastructure. You look for public companies, ETFs, or funds that specialize in owning these assets. You are looking for boring. Boring is cash flow. Boring is stability. When the stock market crashes, the water company still collects its bills. In your retirement portfolio, this asset acts as a stabilizer. Asset class 2, short duration fixed income. The second asset requires us to unlearn a habit from the last 15 years. From 2008 to 2022, we lived in a world of zero interest rate policy. Central banks kept rates at zero. This meant cash was trash. This forced everyone to take too much risk. We coined the phrase, TINA, there is no alternative. You had to buy stocks because bonds paid nothing. That world is gone. TINA is dead. We are now in the era of TARA. There are reasonable alternatives. The second asset you must prioritize is short duration fixed income. high-quality government bonds or corporate credit with short maturities. 1 year, 2 years, maybe 3 years. Why is this critical? Because for the first time in a generation, you can get paid to wait. You can earn a risk-free return of 4 or 5% without taking equity risk. This changes the mathematics of retirement. If you need a 7% return and you can get 5% from safe bonds, you only need to take risk with a small portion to bridge that gap. But be careful, I said short duration. I am avoiding long-term bonds. Why? If inflation stays sticky, long-term interest rates might go higher. When rates go up, the price of long-term bonds goes down. We saw this in 2022. But short-term bonds are resilient. They mature quickly. If rates go up, you reinvest at the new higher rate. You are not locked in for 30 years. Short-duration fixed income is your dry powder, your liquidity. Liquidity is like oxygen. You do not notice it when you have it, but the moment you do not, it is the only thing that matters. Asset class 3, high-quality moat equities. The third asset is where we separate gamblers from investors. When I say moat, I am using a term from Warren Buffett. In the institutional world, we call this quality factor investing. In the US, these are called TIPS, Treasury Inflation-Protected Securities. They are boring, but they are the only asset explicitly designed to guarantee your purchasing power. Here is how they work. The principal value is adjusted upward based on the consumer price index. If inflation spikes to 8%, your principal goes up. You get interest on top of that inflation adjustment. Why is this essential? Because the biggest risk to a retiree is not running out of money. It is running out of buying power. Waking up in 10 years and realizing your $1 million only buys what 500,000 used to buy. Standard bonds do not protect you. Cash does not protect you. Gold is volatile and pays no income. Inflation-linked bonds pay income and protect principal. I recommend allocating 10 to 15% to these securities. Think of it as your cost of living hedge. Asset class 5. Global diversification focused on demographics. The fifth asset. There is a concept called home country bias. If you live in the US, you invest 90% in the US. It feels safe. For the last 15 years, the US market has outperformed everything, and because of that, investors have become complacent. They believe the US will always outperform. History tells a different story. Markets move in cycles. The 70s belonged to commodities. The 80s belonged to Japan. The 2000s belonged to emerging markets. The 2010s belonged to US tech. What belongs to the 2020s and 30s? I follow the demographics. Demographics are destiny. Economic growth comes from more workers and more productivity. The West is aging. Europe is shrinking. Japan is shrinking. The US is aging slower. But look at India, Southeast Asia, Indonesia and Vietnam, parts of Latin America. These are countries with young populations, average age in the 20s, young people entering the workforce, forming households, buying first homes. They are in the accumulation phase. In the US and Europe, we are in the decumulation phase. Boomers are retiring and selling assets. That is a headwind. In the global South, they are buying assets. That is a tailwind. I am not suggesting you abandon your home market. The US is still the deepest, most liquid, most innovative market. It should be your core. But to have zero exposure to the rest of the world is a risk. True institutional capital is global. We search for value everywhere.